morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at one of those stocks that would have bucked the trend of lower earnings in its fiscal year, and we're talking about Massy Holdings Limited, or Massy, for their fiscal year ended September 2020. Now, in contrast to many expectations, Massy would have delivered improved earnings. Let's take a look at what would have contributed to that stellar performance and what investors might expect in the year ahead. So very quickly, for the fiscal year 2020, Massy delivered an earnings per share figure of $7.11, which is a quite commendable increase of 23% from the $5.76 contributed in the prior comparable period. Now, revenues from continuing operations did decline just around 2.1% from 11.4 to 11.16 billion, and operating costs after finance costs also declined just around 7.8%, so a good thing, from 733 to 676 million. Profit before taxes from continuing operations did decline 8.7% from 799 to 729 million dollars, and there were some one-off gains from discontinued operations, which would have increased from 100.8 million to 290 odd million dollars. Overall profits attributable to shareholders improved at that 23.7%. From 563 to just around $696 million equivalent. Now, when we take a look at the segment performance, there were some surprises, and then there were not. There were some performances that were quite expected. In the integrated retail segment, which includes the Massy stores franchises, there was an improvement of around 14% in terms of profit before tax, moving from 324 to 368 million, and that, of course, being Massy's largest segment. Individuals would have opted to shop a little bit more at the grocery as opposed to dining out, forced or voluntarily, and that would have led to an increase in profit before taxes in that particular segment. The surprising or somewhat surprising segments were gas products and motors and machines, where gas products profit before taxes increased just around 3% and motors and machines just around 8%, despite all of the convulsions and closures across all of those real industries and real industry segments, rather. So positive performance and positive profit before tax growth, quite commendable in those particular segments, as well as financial services, which delivered a 10% increase from 109 to 121 million in profit before tax growth. Now, when we take a look at Massy's profit before tax by geographical composition, there were some changes, notably Trinidad and Tobago. Their contribution to PBT would have declined from 47.1% in relative terms in fiscal 2019 to just under 43% in fiscal 2020. Barbados and the Eastern Caribbean marginally improving from 28 to 28.8%. Guyana would have improved over 1% from 16.7 to 17.9%. And Jamaica growing in relative importance also marginally from 6.5 to 7%. And Colombia, where Massy would have quite a number of dealerships, vehicle dealerships would have grown from 1% to 3% in terms of PBT contribution in fiscal 2020. So some notable changes, and that geographical diversification is a good thing, as a matter of fact, and one of the positive drivers or supporters for Massy. Now, in terms of recent developments, quite a positive note would have been the startup of Caribbean Gas Chemicals Limited, for which Massy has roughly a 10% stake, equity stake in, and that as investors may be familiar with, is a plant which would be capable of producing just around 1 million tons of methanol and around 20,000 tons of dimethyl ether on an annual basis. So Massy would definitely benefit from that particular startup in terms of production, at least from a revenue perspective, and the operationalization of a particular asset, a strategic asset, over the medium term. Massy is continuing with its asset rationalization and refocus, and that would have most recently included the agreement of a sale and purchase agreement between one of Massy's wholly owned subsidiaries and Proven Investment Limited for a 50.5% stake in Roberts Manufacturing Company Limited. So that, pending all regulatory approvals, is on the cards and will generate some US dollar cash for the group, which they can utilize within their operations, perhaps to improve efficiencies or to even maybe go ahead and make an acquisition in the medium term if the right opportunity arises. So overall, Massy seems to be heading in the right direction. At a price of $59, the stock is trading at a price to earnings ratio of 8.3 times, which is well below the sector average of around 14 times. and offers investors a dividend yield of 4.2%, which is well above the sector average of 2%. And really, when we think about Massy as an investment for the medium term, it looks fairly compelling, relatively attractive valuations. There is a consistent dividend payment. It's one of the few stocks that actually increased their dividend payment over the past fiscal year. That portfolio restructuring and reorganization of its business units, moving from a traditional conglomerate to an investment portfolio management type perspective, seems to be paying some dividends as well. The growing geographic diversification is a positive driver, but there remains the very big question mark of challenging economic conditions overall across most of its operating jurisdictions across the region. And on that basis, despite most of the positive drivers, Bourse is going to maintain a neutral rating on Massy for the time being. But that's it for this week's edition. For more information, you can give us a call at 2-BORSE or 226-8773. Email us at invest@boursefinancial.com and check out our website where all of our research is absolutely free at bourseinvestment.com. And of course, you can catch us in the business section of today's Business Guardian. Have yourselves a wonderful investing week. This has been the Bourse Report.